In this video, I'm going to teach you how to use options in the most unsafe, risky, and least profitable way possible. Sounds great, huh? One of my most popular videos was on safe option trading, so I guess you guys just don't want to lose money, huh? So in this video, we're going to look at not what to do, but we're going to look at what not to do and how to avoid those big losses that can really kill us. Sure, options are sometimes shed in a bad light and they're thought of as gambling where you can lose all your money. And if you follow these strategies, you could. In this video, I'm going to show you my least favorite and most unsafe option strategies that can be used to lose a lot of money. We will also show real examples on the option trading platform. Hey guys, Darren here. We've got a great video for you here today. For me, it's super important that we are using the safest option trading strategies when trading options. So we want to understand the difference between risky bets and using the math in our favor. So if you haven't downloaded the free options workshop, do that now. And please hit the like button and let's begin. It talks about the two main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. What are some of my least favorite and most unsafe option strategies that can be used to lose a lot of money? Guys, we're talking about buying options. Why is buying options bad? Math. The easiest way to show this is on the option trading platform. Tastytrade is one of the best and most intuitive for trading options. I'll put a link down below. Right now, you can get up to $3,000 when you fund an account. I recommend at least a couple $1,000s in order to be able to place several trades. So many people want to buy call options and then hope the stock price rockets up to the moon. Guys, it's just not going to happen. PunchinAI in the upper left on the trade page. We click on the bid to sell the 42 call option. We collect $180 for doing this since one option contract controls 100 shares of stock. We click on the curve mode and we see the profit zone in green. As long as the stock price stays below the 42 short strike at expiration, we keep the entire 180 collected when we place the trade. You can see there's an 82% probability of profit. Now, let's look at buying the call option, hoping that the stock price takes off to the moon. We click on the ask to buy the 42 call option, and since we are buying the option, we pay $190 as a debit. Click on the curve mode, and we see the profit zone skyrocketing up and going to infinity. That is what option buyers like to see. However, in most cases, it's a pipe dream. Look at the POP, which is probability of profit. It's only 17%. So the chances of us making a single penny are very low. So we sell options instead of buy them for the most part. The only time that I really look to buy options is with leaps options when I go 1 to 2 years out and the theta decay or the time value doesn't kill me. Another one of my least favorite option trading strategies that can lose you a lot of money is trading only one side of the market. Guys, the stock market doesn't just move in one direction up. Let's look at the SPY chart, which is the S&P 500 or total market index. The market moves in jagged stages up and down and sometimes trends one way or another. So it doesn't move in a straight line up or down. So if we're trading in the short term, why not make money on both sides of the market? Plus, we know that every few years, there's typically a pretty big move down or up in the market. We can see where in March of 2020, 12% dropped in one day and close to 30% down very quickly. Now, if you're only long stock in the market, then you lose that full amount and it takes a lot of time to make that back up when the market does rebound. If you were trading both sides of the market and we're delta neutral, then you may lose only half of the amount that you would have lost if you were fully long. And you make a lot of it up on the winning short-sided trades. Then you just roll your long trades out in time and wait for the market to rebound. The next one of my least favorite option trading strategies that can lose you a lot of money is trading too big. Like how I made that one bigger? Trading too big is directly related to the drop or correction in the market we just talked about that may happen every few years. We always want to have money on the sidelines ready to take advantage of any large drops or dips. It's human nature to get greedy when the market is moving up. Warren Buffett's famous quote, "Be greedy when others are fearful and fearful when others are greedy," does make a lot of sense. Options are leveraged, and if we trade too big, then we can blow up our accounts and throw ourselves out of the game. The last of my option trading strategies that can lose you a lot of money is trading incorrect option strategies in the wrong IV. I know there's many more, and I'm sure I'll find them. Understanding implied volatility is important when it comes to option trading. Implied volatility is an expectation of where the stock might move in the future. Depending on how high the IV is, it will cause option pricing to increase or decrease to compensate for the volatility. When implied volatility is high, then option trading premiums are high as well, and vice versa. When IV is low, the premiums are lower. So, if we're selling options, which is what we want to be doing most of the time, we want to do this in high IV so that we collect more in premiums. So stock volatility is a measure of how much a stock's value fluctuates up and down. If the black line is stock A, then you can see that it has very little volatility and stays in the 100 range. The frequency and magnitude of its moves are very small. Stock B in the blue has much higher volatility and makes bigger moves, even though it ends up at the same $100 place. So we like to sell options as opposed to buying them. When IV is high, we collect more in premium. So we want to do it when the IV is 20 or 30 or higher. So we want to sell credit spreads, iron condors, puts, and calls, but all in high IV. The one time when we may want to consider buying options is when IV is low and the stock price is low as well, and we really like the stock. In this case, we do what's called a leaps option, and we purchase it. We have other videos where we discuss and break down the leaps option strategy. Be sure and check those out. This is a strategy where we buy longer-term options 1 to 2 years out to expiration. We want to do this when IV is low, and then we buy the option on sale, and if and when IV expands, our option price expands as well, and it expands as the stock price moves up in value. So some of the key takeaways are we don't buy options, we sell them instead, except for possibly leaps, and then we're going 1 to 2 years out to expiration. We don't trade only one side of the market. Guys, the market moves in different directions and no one can predict if it will move up or down in the short term. We don't trade too big. We don't want to blow up our account, and we want to be able to take advantage and buy in when there are dips. We don't trade incorrect strategies in the wrong IV environment. In other words, we sell options for the most part in high IV. That's the ticket. All right, guys, if you're a beginner or new to options, then this may have sounded a little bit confusing. Don't worry, it did for me as well at first. We will continue to cover many more detailed tips and tricks in future videos, and we will learn and succeed together. I've put a link down below for the free options workshop. Be sure and grab that. Remember to hit like and subscribe, and let me know in the comments below any questions that you may have, and I'll be sure and answer those in the comments as well. And anything that you'd like to see in future videos, let me know. All right, thanks for watching. Share the video with a friend, and I'll see you in the next one.